And one. All right, there we go. Manuel, how you doing, man?
Yes, I'm doing great. Thanks for having me on your show.
Thanks for being on here, man. Um,
Okay.
yeah. Oh, I just got an error pop up right there. Can you still hear me?
Yes, I hear you.
Okay, I think you know what this Zencaster's been giving me errors all day, but we'll ignore that. I think we're good. So yeah, I have a list of questions here. We're just gonna start right away. You cool with
Okay,
that?
let's get started.
All right. So you're an editor at Dow Theory. How did that get started? How did you become an editor there?
It is the because Dow Theory is another website. So I am the editor of the Well, it started when I bought Jack's Shane book already 11 or 12 years ago, The Dow Theory for the 21st Century. And it really changed the way I saw markets. For me, it was really a game changer. So this book was written by a real trader investor to the real trader investor. So it was the Dow theory, but it's, let's say, it's an updated version. It includes the S&P 500, and I was really impressed because it had a real track record. So it was not like most investment books that say, "Look, this is a chart I would have bought here, and I would have made so much money." No, it was different. So he had a track record starting in 1953. So he gave all the trades he had done, and I was really impressed because I realized that book was something actionable.
Mhm.
So okay, so I read the book five, six, 7, 8 times. I don't know, many, many times over, and then I subscribed to his service. So I began as a subscriber because, of course, I wanted to read every month what was his opinion on the market.
Mhm.
And then I was so enthusiastic about his book and website that then I created a blog. So I started blogging about what I called Shanep's Dow theory. So the Dow theory as interpreted by Jack Shanep. So I was blogging and I was also investing my own money according to his rules. And then finally, well, one day he's now 89 years old. One day he decided to retire. And then, well, it was as simple as that. And then he invited me to join, and I said, okay, why not? So, and this is the origin why I became the editor of dataauthority.com.
So you started as a customer. You
Yeah,
got
I started as a customer, really, really. And my blog was really a tribute to Jack Shannon because it really changed the way I saw markets. So, because he was a broker at Dean Witter, so it was a real practitioner. And he was a man, he is a man of no bullshit, really. He goes to the point, and well, it helped me make money. And because I have hundreds of books in my library, but it's difficult to find a book that really teach you how to make money at least in my time frame. I have trades that last more year 1 year, so it is not day trading. More or less, it's positional trades. So on average, we have a trade a year. Sometimes, of course, you add a little bit more, and sometimes you ride that trend, and you are 2 years without any trade, just as we did it from 2020 to 2022. So it was a very long, almost 2 years trade. So this is the story. So then I began this blog as a tribute to Jack Shanep. I was commenting his trades, giving more explanation. And finally, I be from blogger to editor. And now here I am.
wow. That's insane. So I guess he knew you as a student, right? And then you started the blog. He did you have to ask him permission to use his name in the
Yeah,
blog?
yeah, 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 yes. And we were always in contact. He's really a very nice man and very approachable. He's a gentleman. So we were very much in touch. And when I had questions, I contacted him, and he always answered it. And no, no, we had a very good relationship because I consider myself his disciple, and he was my mentor to some
Uh,
extent.
nice, nice. So what is and I'm not a trader. I'm kind of a novice. Mostly do marketing for a stock pilot, which is an auto trader platform, and then we branched off. We have a podcast now, which is what you're on. But if you could explain to me, like I'm five, maybe 10, explain to me what is the Dow theory?
Well, the Dow theory is first technical analysis, so no fundamental analysis. Second, it is trend following. So within the family of technical analysis, it is trend following. Third, it has an extremely long accredited track record. So this is not a new trading system devised by an intelligent guy. No. So even before Jack Shanep, it was popularized by Raya, Hamilton, and other Richard Russell. So there is a really proven, accredited track record, and as I say, it was this record exists before Jack Shanep.
Mhm.
So there are books that contain this record, and we it goes as back as the late 1990, so from 18, well, before the 20th century. So it is almost 130 years track record. So it's really a huge track record. So first it was done by Hamilton, thereafter by Robert Rea, thereafter by Richard Russell, then Jack Shanep, now it's me. But the good thing of the Dow theory is not that it is something new. So we know it has worked. It survived the Great Depression. So it has been traded across all kind of market environments, and it works. So this is the original, what I call the traditional or classical Dow theory. Shanep makes some amendments, some small changes, but even those changes have a track record starting in 1953, so which is also an extremely long track record. So all in all, the Dow theory is trend following, and you could ask what makes the Dow theory different.
Mhm.
Well, I will tell you. First of all, is the principle of confirmation, because I said it is trend following, but there are also lots of trend following methods. You have moving average, rate of change systems, breakout systems. So what makes the Dow theory different? First of all, that we use the principle of confirmation. What does it mean? Confirmation means that we use several indexes. In our case, for instance, the Dow theory, the classical one, uses the Dow Industrials and the Dow Transportation. So one signal derived from one index is worth nothing if not confirmed by the other index. So this principle of confirmation adds lots of value because we get rid of lots of whipsaws. And you know, the whipsaw is the script kryptonite, like for Superman, so it's horrible for trend followers when you get whipsaw. So by using confirmation, many false trades are weeded out. Because, for instance, we have a breakup on the Dow Industrials, but the transportation is not confirmed, so we don't take the signal.
Mm.
Secondly, so confirmation works. Furthermore, you can test very easily confirmation. You can take a moving average system, and if you require confirmation, for instance, you take the Dow Industrials with a simple moving average, something very, very easy. And if you request that at least the transportation also confirms, for instance, if today's close is above the 200-day moving average, then buy, but buy if the transportation is also confirmed, even when using a modest trend following system, a moving average, a breakup system, you will see that your bottom line is increased because even with a moving average, you get rid of false signals. So the principle of confirmation works. This is one of the first tenets of the Dow theory. Secondly, of course, is that we use several indexes and we get a higher signal to noise ratio. Thirdly, and this is very important, the Dow theory is similar to a breakout system, but there is a big difference. Only relevant pivots matter. So when you have a breakout system, you will be trading the, I don't know, the 20 days high, you will be selling the 20 days low, 40 days, whatever. But if you look at those 40 days high, 40 days high, etc., on the charts, you will see that they are undistinct points on the chart. So it's not a clear pivot. A 20 days high can be any day high. So it is not a specific pivot on the chart. So on the Dow theory, since we use secondary reactions, only important pivots on the chart are the valid breakout systems. So this is very important because we are not just taking, I don't know, a 20 days high or 40 days high or 20 days low. We're taking whatever end days high, but on important pivots on the charts. So you could ask, how do we get these pivots? So how do we separate the wheat from the chaff, the important pivots from the relevant ones? Because the Dow 30 for a fifth tenet uses secondary reactions. And what's a secondary reaction? Well, we have the primary trend. Let's imagine we are in a bull market. So we have the primary trend is going up, higher highs, and then suddenly there is a setback, there is a pullback, and then prices go down. And then this is a secondary reaction. But of course, how much down? Because on the Dow theory, we have everything under control, because otherwise it would be subjective. Okay, I said there is a pullback. Okay, but how long? How deep? Okay, we have rules for that. For instance, in our own Dow theory, under Shanep's Dow theory, we require we have three indexes. We require that the average pullback last an average of 8 days as the average of the three indexes. So, for instance, one index, maybe the industrials, has declined for 5 days, but the transportation and the S&P has declined for 20 days. So, since the average 5 plus 20 plus 20 is 45, the average is much larger than 8 days, then the time requirement, get that, the time requirement for the secondary reaction has been fulfilled. We also require a minimum extent for the decline. So if the decline is, for instance, 1%, even though it can last many days, then it is noise, it is relevant. So we also require that at least any pullback has an extent of 3 or more percent. So when you mix the time requirement, so at least 8 trading days as the average of the three indexes, with the extent requirement, at least 3% confirm, once again, principle of confirmation on at least two indexes, then you get the relevant, you can single out the relevant pullbacks. So not any pullback. So we have an objective criteria to measure what is an important pullback. Once we get this important pullback, both in time and extent requirements, then we have what we call a secondary reaction. And then the end of such secondary reaction, these are the relevant pivots we focus to single out the relevant breakout points. So in this aspect, the Dow theory has nothing to do with other trend following systems. Compare this with a normal breakout system. So we are not taking a 20 days high, 40 days high. No, it depends. Sometimes it can be a 10 days high or it can be 100 days high. It depends on the extent and time requirement. But for instance, if a decline has only lasted 3 days, even if it's a very deep decline, pullback, this doesn't qualify as a secondary reaction because it didn't last enough time. So by by specifying the relevant pivots, secondary reactions, then we have the relevant points on the charts that are really important to be broken up or down to define the change of a trend. Because once we get a confirmed break up or breakdown, then we get a buy or a sell signal. So this is basically the Dow theory.
Interesting, man. That's a big explanation there, and it sounds like it's like, could you almost say it's like a formula that you would follow and then input different things with whatever you're watching?
Yes, it does not. Good question. It does not lend itself easily to being coded, programmed for a computer, but nonetheless, we have our rules.
Right.
So, so for instance, the concept of secondary reaction, which I insist is vital, because the secondary reaction defines our pivot points. It has objective rules. We need the average of the three indexes the industrials, the transportation, and the S&P, the average of the three indexes should be equal or larger than 8 days, 8 trading days. We also require that at least the S&P and one other index declines by at least 3% or more. So this is objective, so you can measure on the chart. So there is no room for subjective interpretation. So we have our rules. Yeah, yes, clearly. Furthermore, on the subscribers area of our website, we spell out all our rules. So all what constitutes a secondary action, what is a valid breakout. So and it's not so complicated. Once you get acquainted, well, I could do it, and many people have learned to use it.
Okay, very cool. So on the website, right? That the DowTheory.com. You guys have three indicators, or sorry, two indicators that you put on there. And I'm sorry if I'm saying his name wrong, but the Shanep timing indicator,
Shannon indicator.
Shanep, Shanep.
Well, it has been discontinued because now it's the blind time indicator. It's very similar to the Shannon time indicator, but it is an updated version, which performs a little bit better.
Is that
So, and this
sorry?
is what I call the blind time indicator. We have the Dow theory for the 21st century, which is our Dow theory flavor,
Mhm.
and then we mix the two indicators into the composite. So I always say that I like to fly with two engines, with two motors. So a plane with only one motor, well, you can fly, but what if
Yeah.
the motor fails? And you know that I make no pretense of knowing everything. You know that in trend following, we have also spells of underperformance. So trend following, even with the Dow theory, is not a straight upward line. No, we also have drawdowns, we have whipsaws. So no indicator works perfectly all the time. So by using two good indicators, we can weather the drawdowns and the spells of outperformance much better. Because, for instance, let's say that we got whips up, there was a whipsaw under the Dow theory. Okay, but maybe the blind timing indicator is performing okay. So then we mix these two indicators, the blind time indicator, which is also long term, so it also triggers a trade roughly once a year. So both are long term oriented. The two are a very good match, and the two, even though they are correlated, there is correlation because both of them are trend following, but it is not a huge correlation. So they are slightly correlated, but since they are not 100% correlated, this means that we get signals not on the very same day. So sometimes we have one invested, the other one remains in cash. And by using two engines, our plane flies with much less volatility. And this is the goal, because when we take signals from the two indicators, we get less whipsaws, and it's a much smoother ride. And this is all because my goal, because I eat my own cooking, so I am also so it is not that I publish the letter. I publish the letter, but I take the trades,
You
and I've been
use
taking the trades. I've been a trader for more than 20 years now. So my obsession is drawdown reduction, and both in depth and in time, because the drawdown kills the investor. Because I know you can do a back test and you can say, "Oh no, well, it was a 25% drawdown. I can live with that." You can live with that in hindsight, but in real time, you will chicken out. You will chicken out in real time. And I know that because I know my frailties, I know my weaknesses. So my obsession is to reduce that. And I would say enemy number one is the time in drawdown, not even the depth of the drawdown. The time in drawdown is what prompts many trend followers to throw in the towel at the worst possible time. The time, because even if it is a meager 10% drawdown, if it lasts 4 years, I can tell you the most trend followers will give up for good. Even a meager 10% drawdown, but if it lasts 4 years, very few people will stay the course. So I am obsessed with drawdown reduction, both in time and also depth, as both aspects. So we have to try to have, of course, small drawdowns, but also the timing drawdown. And this is why I use two different indicators, because sometimes one indicator has a dry spell, but the other one is shining. So by using the two, then I'm reducing the time and depth of drawdowns, and it makes the system more tradable in real life. Because I repeat, most of us, as legendary trader Paul Tudor Jones said, don't play macho with the markets. He said so. We are all very brave when you are back testing, but in real life I can tell you, you will endure half the drawdown you thought you would endure. And this is human nature. So you can have the best trend following system, but if you don't control drawdowns, eventually you will give up at the worst possible moment. And this is why what you mentioned, we have these two indicators, because I don't trade at authority, nor I trade a blind time indicator. I trade them in what I call the composite, which is an index. Well, the composite is the composition of the two separate indicators.
Mm. That's the composite timing indicator, correct?
Exactly, a composite timing indicator.
And these indicators, so I could use that, right? Me just being, say I'm Joe Schmo, I'm a trader. I go to the DowTheory.com. Can I download these indicators and use them
Yes,
myself?
yes. In our letter, in our monthly letter, we update the state of our indicators. And of course, if there is a signal during the month, we send an email, and also Discord. There is also Discord, an email alert to our subscribers. So as I told you, our indicators trigger seldom. So this is not swing trading nor day trading. So maybe there is a spell of 6 months without any trade. But of course, if tomorrow there is a trade, I will let you know. An important question, by the way. When I say that our indicators trigger very seldom and that we maybe get one trade per year on each indicator, this does not mean that our indicators can trigger every day. And look, because there is a dirty trick that many people touting very basic trend following systems, for instance, they take monthly bars or weekly bars, and they say, look, this system would have only triggered one signal per year, and it looks great when you look at a backtest. But there is an issue that makes them untradeable in real life. If you use monthly bars and you can only trigger a signal once a month, you run the risk of having a killing drawdown. Because can you imagine in March 2020 with monthly bars? Are you going to wait to March to March 31st to get the signal? Of course, if you look at a backtest and you were lucky enough to avoid such a horrible month, then your backtest can look great, because I read lots of. I think I've read all trend following books that are out there. So this is a typical trick. We use weekly or even worse, monthly bars. We create a back test and we say, look, this system was great. We cut drawdowns by half. We outperformed by 2%, and only with one trade a year. Wow, this is a boon. It's great. But the, the issue that it does not the ability to trigger every day. This is very dangerous, because one day you are going to get really caught in a big drawdown. So our indicators, both the Bly and the Dow 30 for the 21st century, while they trigger very seldom, once per year on average, they have the ability to trigger every day. In other words, we use daily bars. So my charts are based on daily bars. So at the close of each day, we can get a buy or sell signal. And this is a very important thing. We can get it, but we don't get it. We get one signal on average per year. But the system evaluates, assesses the market situation every day. And this is a very important aspect,
Because you never know when that alert might.
because you never know. Picture yourself in March 2020. The market is going at the end of February, beginning of from February 22nd, 23rd to March 2020. Picture yourself during these 40 days. The market action was too quick, so you cannot be trading with monthly bars, even if eventually you recover from the drawdown. But in real time, you're going to panic because we have emotions and we cannot forget the emotional aspect. So you have to have the comfort, the relief of knowing that even though you are not day trading, not even swing trading, but that every day your system is able to get you out of trouble. And this is a very important thing. And this is and now if you check carefully most trading trend following systems that trigger seldom, they do this trick. They use weekly or monthly bars because otherwise, if you are, for instance, trading with moving average breakout systems, if you don't do this trick, it is a trick of using weekly or monthly bars, you are going to get many signals. Even if you take a 200 days moving average, something theoretical long term, and there are lots of whipsaws. So, of course, to get rid of those whipsaws, you say, okay, I'm going to evaluate or assess once a month. And of course, then you get rid of many trades, of course, because you're only assessing once a month. But you risk the knife, you run the risk of catching a falling knife until you get the sell signal. And also belated entries. Because, for instance, in 2020, we had to be very, very swift, very quickly in leaving the market, but also we were very quick in re-entering the market. Because if you remember February, March, and April 2020, it was unbelievable. For instance, on April 6th, the market had already risen rallied from the lows more than 19%. So we had and insane volatility. So are you going to wait till the end of April to get your buy signal? For instance, we got our full invested signal on April 6, 2020, because of course the market was running very high. So on April 6, our bull market criteria was met on our two indicators. So we went full invested.
Hmm. And an alert was published on April 6th.
Yeah, on April 6th, there was an email to subscribers. And then in the end of the month, we explained, because of course, every day, if there is a signal of there is the likelihood of a signal, we email immediately. We email before the close. Of course, we sent an email, and I will never forget because I trade it. It's my own trading.
You use these indicators, and these indicators. So say, can they get used with any brokerage?
Well, I use TradeStation
Oh,
personally. Trade for more than 20 years.
okay.
TradeStation.
I actually just spoke with a lady. She was on my, not the last episode, but the one before that. A lady that was with using TradeStation since the '80s, and but they weren't even called TradeStation. It's funny, but we actually use TradeStation as well. They're great, but we use them for our auto trader. So that's cool. So is it just TradeStation that we can use these indicators with?
Well, as I told you, the indicators themselves, they are not so easy to code. But so I enter the trades manually. So I go to the order bar, TradeStation order bar, the Dow theory especially, and also the blind time indicator. We use margin debt as one of the parts of our indicator. So it's not so. So I can derive the signal, but for instance, I, I have to. So margin debt is not an input in TradeStation. So I can code it, and I have it coded on easy language TradeStation, but I have to derive margin debt from another sources, and so I do it manually. But especially the blind time indicator, it could be programmed, but I feel safer doing my own calculations.
So with this the Dow theory, right? You mentioned that there's a track record from the '50s. Is that for the Shanep? The
Yeah,
Dow
Shannon,
theory?
Jack Shannon.
and we can look at his track record using the Dow theory. We can look at that back into the
Yes,
50s.
most of the trades are there because before creating our newsletter, he was a broker and he was sending memos to his clients. So I think the earliest memos, say buy, sell, all these things, I think they date back from the 50s because he's 88, 89 years old. So when he was in his early 30s.
That's
So,
really
and they are included in on the subscribers area. There are all these memos, and you can see what he was doing already very, very long time ago. His memos to clients, for brokers, brokerage firm.
that's awesome. So that's, I mean, that's complete transparency right there, and confident in his own system essentially. So
Well, he's a very bold man. I tell you, he's even bolder than I. Much bolder. He's really bold. Is because I've lived with him drawdowns and he's really wow. He's a very brave man. Well, he was a pilot in the U.S. force, so yeah, it's a great story. He was a pilot, and well, he's a very brave man. He served in the army, so he's a bold old pilot.
um, this isn't a question I have on here, but where are you calling from? Are you in the U.S.?
No, I live in the Dominican Republic, and this is why I apologize for my Spanish accent. But I'm a Spaniard. I'm not a Dominican.
Oh, okay, okay. No, man, no need to apologize. I my Spanish it's gotten worse over the years, but my Spanish at one point was really, really good. I learned it from it's like Mexico Spanish, but
Hmm.
it was man, it was really good. I wish I could speak Spanish to you right now, but it's not there anymore.
Well, I think now if other people are hearing us, it's not. No, no es el momento ahora. Now is not the right moment.
Right, right. So back to the questions on here. Now, with the newsletter, and you kind of already answered this, but maybe this would clear it up a little bit more. But right, there's on average one trade a year. Now with the monthly newsletters, what do users get with that? Is it more so like information on how the market was doing that month, and like, hey, we can almost kind of predict like in the next 3 months we'll probably get ready for an alert here, or what does that look like? Because the newsletters are monthly.
Yes, yeah. Let's say there are two sections. On the one hand, we update on our indicators with charts, tables, and say, look, you are here, and also we anticipate, as you said, for instance, now there is a secondary reaction, but if this and this happens, then we will get a buy signal, for instance, or a sell signal. So even though, of course, we are going to update real time through emails or Discord
Mhm.
during the month. But of course, in our monthly letter, we say, look, it is very likely that in the coming days, this and this will happen. And if this happens, then you will get a buy signal. Then we provide the charts and we highlight the relevant key levels to be broken out or down for a buy or sell signal. So even though maybe it has not occurred yet, we are giving our subscribers the big picture and with charts, tables. Look, you have to look, or for instance, if this price level on the Dow Industrials and this price level on the S&P is broken up, this is a sell. So please mark these numbers. So we provide charts, and we also have the second area of our letter. We keep a look a little bit on the economy, not because we believe that much, but we have an extremely good record at forecasting recessions. And also, our forecast of recessions has also a bearing on the vagaries of the stock market.
Yes.
So we also pay a lot of attention, for instance, to the inverted the yield curve, consumer confidence index, which also has a predictive power of recessions, and some pet indicators we have that these pet indicators, they are not trading systems in themselves, but they are very good in forecasting the top of a bull market and also the onset of a recession. And of course, we talk about such things. And of course, for instance, now we are seeing that it is very likely that quite soon, let's say in 4 months, 6 months, there is a recession based on what we see on our indicators. So of course we talk about such things.
And I've actually I read on your website or on the dowtheory.com, you guys are pretty proud about the performance you were able to do in those big stock market crashes. I mean, historically, from 1987 on up, right? Uh,
Mhm.
so can you talk on any of that? Like what does the performance typically look? Do you still on average on those stock market crashes? Do you still do typically one trade a year on that, or does it increase, or does it slightly
Well,
decrease, or what was that like?
no, no. The stock market crashes are part and parcel of the one trade per year average. So, but this is a very good question because we have a third indicator which complements the other two. It is a prop. So it is not a trading system in itself, but we use it to derive signals for the blind time indicator and the Dow theory, which is called capitulation. And capitulation is a bottom picking indicator. And we have also a track record starting in the 1960s, so it's also a long track record. It triggers very seldom, on average, every 4 years. So we only single out one bottom, and in this specific case, we catch a falling knife. Because I told you we are trend followers, but we want to make money. So I'm not so dogmatic. So okay, I am a trend follower, but if I see an opportunity to make money by mean reversion, then I will mean revert. So because this is not a religion, these are the markets, and you have to be eclectic. You have to be flexible. So capitulation is an indicator that was created by Jack Shane, which bets on a mean reversion, but of course not any mean reversion, because most of mean reversions will fail because don't ignore the trend, don't fight the trend. But occasionally there are times when it pays off to be a contrarian or to be to fade the trend. So this capitulation indicator, more or less, it triggers more or less every 4 years. It triggered it in 2001, 2002, 2008, 2009, 2020, 2018, December 24th. There was also a big decline, and we pick the exact date of the bottom. So on average, our capitulation indicator is on average 2.5 days um, before or after the bottom. So it means that it has a great accuracy in pinpointing bottoms, but really important bottoms. Look at my dates: 2000, March 2020, December 2018, 2000, February 2009, 2008, 2002, 2001. The crash, the October crash, the day of October crash, in the end of the day, our capitulation indicator was screaming go long, but we had gotten out a couple of days before, so it was a great trade. So it singles out really important bottoms, not minor bottoms. But this is capitulation, to so that you can understand. It is like a stretch rubber band. Imagine a rubber band and you stretch it to the point that then it snaps back and then it reverts. So we use several indexes and several proprietary measures, but in a sense, it's very simple, really. But it's proprietary that anyone putting a little bit of effort can unlock the secret just by reading our website. But you have to put a little bit effort. But if you put a little bit effort, you can unlock the secret. And I tell you, it's a couple of lines of code, but you have to. And this can be programmed, by the way. It's easy to program. And once the rubber band has become too stretched, it tends to snap back and then goes back to normal. And then on capitulation, we advise not to go 100% invested because one never knows what is going to happen in the future because we are fighting the trend. We advise to go 50% invested just in case. But of course, we have all the calculations, and if one went 100% invested on capitulation, one would increase performance. But you know that our worst trade is always ahead. So mm, I don't recommend going 100% invested. We go 50%, and I think it's a good balance between being too aggressive and too shy. So this is our bottom picking indicator, capitulation.
That's a cool one. That's pretty interesting. I mean, it makes sense. You would want to know when the bottom is for those big points of time. So this next question, I mean, this is a lot of information here. I'm a novice. I'll be honest. My specialty is marketing and stuff like that. But could a novice go to the dowtheory.com and use these indicators? Like say somebody that's decent with trading, but like not too knowledgeable, not an expert. Could they use these indicators and get a grasp on it pretty easily, or how?
Yes, definitely, yes. For two reasons. First, because in our subscribers area, we provide the full explanation of our time indicators. So we say if this happens, then you have to do this, and that. So all the rules are spelled out for the Dow theory, and for the time indicator, while it is proprietary, but I also give so many clues that someone, once again, putting a little bit of effort can unlock the secret because it is a special report giving all the details how it works. So it's almost all there. So if you have on the one hand all the deep explanation we give, we provide the track record. So it's not only the rules. Look, this is here you have all the buy and sell signals. What we did, you have all the information there. And secondly, we also in real time tell you when a signal is coming. Then you have all the elements to trade it because you have all the rules spelled out. We provide in real time. Watch out, a signal is coming. And furthermore, we have also our own what we sell real portfolios. So I have my own portfolios and I post on the website on our monthly letter how I'm doing, if I'm doing well, if it's okay, if it's a drawdown. So it is there for all to see. So well, I myself started as a subscriber. So the best answer, of course, anyone can do it. I'm not going to lie. It requires a little bit of effort because my trader experience is that you have to master a thing to really have faith because there are losing trades. More or less, our batting average is 70%. So there are 30% of losing trades. Watch out. So I'm not saying that, but we do know miracles. But this happens to. But if you compare to other trading systems, our batting average is very high. And also, when we lose, we don't lose big because keep your losses short. It's trend following. But of course, I'm not promising. Oh no, we are great and we win all the time. No. There are also drones much smaller than the drones of buy and hold, but there are also drones. There are spells of underperformance. And but what I mean is that if someone puts a little bit of effort, it is doable because I had no idea, and by reading Champ's book and following his letter, I was able to become the editor of the letter. So it means that it can be replicated. It can be learned.
I mean, it
Definitely.
makes sense because if he's open to it, obviously, even beforehand, they were like, "Hey, watch the track record of the Dow theory," and then he took it, did his own spin on it since the '50s, and he's like, "Yeah, look at my first trade," and then you probably came in as a novice as well, and then learned it for yourself and became the editor. So it only makes sense that I guess it does work, right? Um,
It works, but sometimes investors they want shortcuts, and to be successful in the markets, there are no shortcuts. I'm sorry, but it takes effort because you have to have absolute confidence in your trading system. And I know this because I'm weak. I'm a weak human being. So if you don't have absolute confidence in your trading system, you will chicken out when the going gets tough. And there is another thing for beginners. Normally, there is Murphy's law. So your first trade is going to be a loser. This happens. No, no, this is Murphy's law. So most likely you will. It. But I know this because sometimes I get emails, and I've been checking your performance, and I was seeing all your winning trades. It was great, and my first trade it has been a loser, and they bemoan. They say, "Oh, the wine, oh." And this is Murphy's law. I say, well, this is normal, but most probably next one is going to be a winner. But Murphy's law, normally your first trade is going to be a losing trade. But okay, this is part of parcel of trading, and we have to live with that.
It's like the first test you get almost. Are you going to stick around if you take a first loss here? It's almost like the market's testing them.
Yeah.
Um, so, okay, we're running on about 45 minutes here. I have a couple closing questions for you. Is there anything new with the DowTheory.com or anything maybe personally that you're working on that you're excited about?
Well, I'm working because since it's my own money, I'm obsessed, this kind of obsession, with reducing drones even more, both in time and depth. But of course, this is still, I'm still researching. Well, I can tell already that those bold enough, if you short our time indicators, we have an edge when you short. And furthermore, shorting ability tells you a lot about the accuracy of our timing indicators because on the long side, it is quite easy to make money, especially if you are stocks. But when you really test a trading system, a trend following system, is when you short. And if we short, we get an edge. More or less, we make 2% annual if you short. But this is a lot of time because on average, we are short 20% of the time, a little bit less than 20% of the time. So if you make roughly 2% by being on the time only 20% of the time, it equals roughly to 8% by going short annually, which is a lot when you are fighting a bullish bias in the stock market of circa 10% per year. Don't forget that there is a drift, a bullish bias on the stock market on average 10% per year. So when you go short, you can make 2% by being on the market only 20% of the time, which translates into annualized 8% per year. So this tells you a lot about the accuracy of our time indicators. That even fighting against a bullish bias of 10%, we can make 2% on average every year by going short. And this is my current project. I'm really studying a lot, not only shorting but also going long bonds and gold when they are in a bullish trend when there's a short, and but it's still being researched, and probably this is going to be a silver or platinum subscription, I don't know, but it's not there yet. But I'm going to eat my own cooking, of course.
Nice, nice. When do you expect it to be fully launched or not? Don't really know yet.
I have no idea because I'm really very short of time, and I have to be extremely convinced. If I'm not extremely convinced, then what I cannot eat cannot be given to my subscribers. So I have to eat it first.
I like
To
that. I
take
read
my
that.
own poison. To take my own poison first. So
Yeah.
I really don't know. Maybe 1 year. I don't know. No idea.
Okay. When did you start working on that?
Well, work is never-ending quest, but now I'm really making great inroads. It's
Nice.
for the last weeks I'm making great inroads.
Very cool. So for the viewers or the listeners, can they contact you, and if so, how?
Yes, of course. Uh, Editor at thedowtheory.com. I repeat because of my accent. Editor at thedowtheory.com.
And they can just shoot you an email, ask any questions, maybe get
Yeah,
connected
yeah, of course.
forward.
Until now, I've been able to answer all emails. For the time being, I still can.
Very cool, man. Well, hey, this was a lot of fun. Thanks for being on the show, man.
Thanks to you, Jackson, for bringing me here. It's a
Awesome.
pleasure.
Hey, absolutely, man. Have you come back anytime.
Okay, always there. It's been my pleasure. Thanks a lot.
Yep. Have a great weekend.
Okay, same to you. Bye.